Welcome to Founderline. I'm your host, Joe Beninato, and it's great to have you all with us today. This is our first show of Founderline, and I'd like to take a moment just to tell you why we're doing this show. I've been involved in startups here in Silicon Valley for 25 years, and I love being involved in startups. I know how hard they are. I've been CEO of multiple companies. I've been on the exec teams of even more, and there's some great days. There's some really tough days, and as we were starting to think about this show, what came up was a forum for founders and startup people to go ask questions and get their questions answered by people who have been either entrepreneurs or investors in those companies. So maybe you're thinking about starting a company, maybe you're working at a company currently, thinking about, hey, what are my stock options worth? What's going on? Is this company going in the right direction? Should I take this job offer at a hot new startup? Whatever it might be, we're going to try and answer those questions in the hour that we have today. So if you have a question, we'd love to try and help you. You can reach us a bunch of different ways. First and foremost, this is going to be an interactive show. So we have an 800 number. It's toll free. You can call 1-844-4-FOUNDER. And yes, there's an extra digit in there. Don't forget the extra 4. You can email us at help@founderline.com, or you can tweet to us as well. The Twitter handle is @Founderline, FOUNDERLINE. And if you want to submit something anonymously, you don't want to have your name attached to it, you can go to our website, and there's an Ask a Question tab. You can enter something in there and just hit submit, and we'll get those via email as well without any attribution, with your name attached to it. So this is going to be a little bit of an experiment. We're doing this show live, and when I told people we were going to do this show live, everyone thought we were crazy because just the challenges of the technology to get the phone calls and answer the messages. But we figured that's the best way to do this, is have it be interactive and have people out there who are watching it live, maybe hanging out at a company together, watching it right before happy hour, or maybe happy hour is starting right now. Who knows? But we just thought that would be the best way to interact with people who are interested in this topic, and we're gonna do our best. We're gonna screw up for sure. Hopefully, we'll have some fun along the way, and we'll just see where it goes. So with that, let's get the first episode started. I want to introduce our first guest in the inaugural show. This is Saar Gur from CRV. He's a general partner there. And Saar and I have known each other a number of years. He's been both on the entrepreneur side as well as an investor. Companies like Twitter, Brightroll, Dropbox, and DoorDash. So he knows what it's like to be in your shoes. If you're the founder of a company or an executive or just working at a startup, he knows what it's like. So Saar, welcome, and thank you for being our first guest.
Really honored. Thanks for having me.
It's so great to have him here. And what we're going to do is before we dive into some questions, I always think it's helpful to know a little bit about the people. So it'd be great if you can talk. Maybe start with some of your adventures
Sure.
back when you were working as an entrepreneur or at some startup companies. Maybe share a couple of anecdotes or stories from that, to help people know a little bit more about you.
Yeah. Well, thanks again for having me. My background before I got into venture is, and as you know, since you're a close friend, even today, I continue to hack at a lot of businesses, and many
right.
of my investments have been I've been involved at the earliest stages of helping things get started. But right before I joined CRV, I was working with one of my best friends, Todd Setcher-Dotty, to help start a video ad network called Brightroll that's gone on to do very well. Before that, I was at a startup called Adteractive that some friends of mine had originally started on a credit card, and I joined them, and we built that business to about $160 million with no outside capital.
Wow! Just bootstrapped it from.
Bootstrapped.
Wow.
From a credit card, and famously, along the way, had opportunities to potentially sell the business for lots of money, and unfortunately made a number of bad decisions along the way that led to that company not being worth anything.
Oh wow, that's tough.
That's tough. Yeah. Otherwise, I've helped start a number of companies, many things that started as projects that did not work out at all and sort of cratered and died. Before I joined Adteractive, it was in the heart of the dot-com bust. I wrote a business plan with another one of my good friends, and we actually worked on a big real estate project where we raised about $10 million and bought 22 properties, created a land assemblage, and hired a bunch of people.
Wow!
To do that,
I didn't know you were a real estate mogul. Also, that's good to know.
We were lucky with that one. We sold that one and did quite well. But and then, as you know, my wife and I own a small chain of little yogurt cafes here in the Bay Area.
Yeah, Fresh Yogurt. For those of you who don't know,
right.
Place to go in Palo Alto, and is it one in
San Francisco and Stanford and San Francisco. So
awesome.
Yeah.
She'll be happy you gave her.
That's right.
Gave her a plug today. Awesome. Well, so you're involved in a bunch of these companies, and then how did the transition to VC go? I think you're doing some angel investing along the way, and then eventually joined CRV. Is that right?
Yeah, it's funny in this environment to try and remember what the dot-com bust was like, and especially if you're a younger entrepreneur, you may not even know. But at that time, I was helping run businesses and was busy operating, and there were a number of entrepreneurs who were starting companies in the dot-com bust where investors really were not interested in the internet. If you can imagine, the internet was really exciting in the dot-com days. Lots of venture capitalists and angel investors sort of piled money in. Yep. And then in the dot-com bust, a lot of VCs lost their jobs. Many of them were focused on fixing their portfolios. Many folks who were quick to make angel investments in the dot-com days pulled way back and realized that the good times were over and they may not see those big sales again. And while I was operating, again, I ended up working with some entrepreneurs at very early stages where I wasn't trying to be an investor. I actually, just being very passion-oriented and loving helping founders, got involved in some companies at very early stages where I ended up making some investments really to help them more than trying to be a rational sort of investor. And in doing so, I just got lucky that some of those companies ended up becoming meaningful businesses at the time here in the Valley. And I got involved in helping a number of them raise venture capital, helping a number of them get sold. And somewhere as the dot-com bust sort of, I guess, hit the bottom and started to come back, a number of venture capitalists tried to convince me to do venture and thought I might actually be good at it. And a number of my entrepreneurial friends who had come to me for advice over the years also were encouraging me, thinking I might be very good at it. And so after about 2 years of not wanting to do venture and thinking I would continue to operate and sort of getting this feedback and then thinking I might really enjoy it, I ended up meeting the folks at Charles River Ventures and joining them. And it's been a ride ever since.
And still headquartered in Boston, or have you still have 2 offices, right? Or how's the split now? I know it started obviously out in Boston.
So CRV started now over 40 years ago outside of Boston, in Boston, and over time we've sort of migrated a lot of the partnership west. So today there are actually more folks on the West Coast than the East Coast. We have, I'd call it 2.5 partners who are based in Boston, and the rest of us, call it 6.5 folks, are based on the West Coast, and the half is one of my partners who basically spends half his time between the 2 coasts.
Got it.
Yeah.
Great. Well, I think it's always helpful to just sort of understand and I always tell entrepreneurs that I'm helping out with their companies, like, the best investors are the people who have actually been in your chair before. So they know about the ups and downs. They don't freak out when weird things happen because they've been through their share of those as well. So great background. If any of you have businesses that you want to talk to Saar about, you can tweet at him. His Twitter handle is @Saar, Saar, Saar, and he'll be sure to take a look at those, I'm sure. So let's try this grand experiment. We've got actually a couple of callers on hold, and we'll see if this actually works well. But I am going to turn on the microphone, and we have Aaron on the line from the 303 area code. Aaron, do you have a question for us today?
Yeah, Joe, thanks for taking my call. I have a question I think both of you guys are very well qualified to answer. It's an age-old question that entrepreneurs want to know before they build something. How do you validate an idea?
How do you validate an idea? Thanks,
Yeah,
Aaron.
it's a great question.
So, it's for you.
Sure.
Take it.
Yeah, it's a great question. And, I would actually say that one of the real talents that we see from entrepreneurs who have started a number of businesses and have built a number of companies is they really develop a talent both in having great judgment into how to test an idea quickly and really test the core of an idea simply and easily. A first-time mistake we see for a lot of entrepreneurs is they sort of overbuild their first prototype. And there's really a skill in now what many people call an MVP that's really supposed to test that core value proposition, test market demand, test the value proposition to the user, whatever it may be. And it's hard. It's very hard to do. But generally, we find that through practice, often what we find is people will overbuild, and they really, it takes a skill to sort of be creative and reduce all of the features down to the core of what the idea, really what you're trying to test in that initial prototype. Hopefully that's the beginning of an answer.
No, that's great. So we've got some emails coming in, and bear with me while we're sort of filtering through these. My producer Joel is sending me some of this stuff, but we're gonna have to fight our way through figuring out. So I think next one we're gonna have is another call. This one is from Hong. Let's see if we've got Hong. Are you on the line?
Hey Joe, how's it going?
Good. How are you? Would love to hear your question.
Great. So I think you spoke about earlier. A lot of these startups, you start working on things that you're passionate about, but I see this seems to be a kind of diametrically opposed to what VCs are looking for, which are these large, very, very large exits these days. Like anything under $1 billion doesn't seem to be making news. How do you know? Like I feel like things I work on that I'm interested in all seem like good ideas, but they all look very, very small at this stage. How do you know that you're onto something that could potentially be a huge $1 billion business?
Great question.
Yeah, Hong, it's a great question. I think there's a number of ways to answer the question, but I guess first is just in terms of market size and market potential is one way to cut it. So depending on if you look at the fundamental value proposition of the product and who that addresses, you can start to figure out is that a large market or not a large market. So if you're serving, as an example, if you're serving males between the ages of 60 and 61 in the Mountain View zip code, who like wearing blue shirts, you're sort of limiting yourself in terms of how big of a market you can build and whether you'll be able to build a huge business. If you now say we're going to serve all Americans or everyone in the world, then you start to have a huge addressable market. And if your product really resonates and really is 10x better than other things in market and can really reach those folks, you can start to paint a path where a company can get very big, even if initially it looks very small. There's lots of examples, and often investors make big mistakes in making the wrong call as to whether a technology can go broad or is it narrow. A classic example with the recent press around a company like Uber is many folks early on thought Uber was just going to be in the town car market, and then there were debates on whether the black town car market was a big enough market or not. other folks that said, well, Uber could become the Expedia or Hotwire of ground transportation. They could become the booking engine, saw a much bigger vision and a bigger path. And you often don't know as an entrepreneur when you're starting, but if you can paint a line, even if it's not a solid line, but a sort of dotted line to how things could get more interesting over time, that's often a good indicator that you may be onto a bigger idea.
Awesome. Thanks, Hong. We've got a bunch of emails coming in. This one's actually pretty interesting. This is from someone named Douglas in Lagos, Nigeria, and the question is, how do I get an investor for my ceramic ware manufacturing project from the USA? So, and there was more to the email, but we filtered it down to that. Basically, apparently they build ceramics there in large numbers, and he's actually talked to a number of investors over there and is now starting to look for investors over here in America. So, probably not your typical technology VC investment, but maybe you can give him some tips about some things you might be able to look at.
Sure. Yeah, it's not a question I think about it every day, but I would say, there's different types of folks that might be interested in investing in Africa. Starting with folks like myself who are sort of professional investors, they'd really need a compelling story for why there would be a great return and a better return than other investment opportunities that they may have in front of them. So without knowing more about this specific ceramic opportunity, it's hard to say whether this would get anyone's attention here relative to other opportunities they may have. Because there's also additional complexities to the average investor in investing in Africa, whether is it legal to invest in Africa? Where do I send my money, and do I trust the banking system? As well as, one of the key issues in any investment that's related to early stage investing is that you're investing in the team. And the fact that people don't know you and don't have a relationship with you can make it quite challenging for someone to actually bring out their checkbook and want to invest in a company that's so far away with people that they don't know. So I guess if I were in your shoes, I would say I would probably look towards people networks or proxies of folks that do know you well and have a point of view on the business, that can be either they trust you and have capital, or they can be proxies of trust for other folks that are stewards of capital, as a way to think about where to spend your time trying to find money. Otherwise, I think it's challenging. I think there are another set of investors, folks that have, like Kiva and Vitana and other organizations that have helped facilitate flows of funds into places like Africa, and those are probably great people networks to try and get to know and surround yourself with, because they've got strong connections into the U.S. capital markets as well.
Awesome. Well, we're gonna switch back to the phone. We have a call. Let's see, from Ryan in San Francisco. It's about founder compensation. Let me switch it over here. Ryan, are you with us?
Hey, Joe, it's Brian.
Oh, Brian. Hey, Brian. How are you?
Hi, good afternoon. My question, just real briefly, is, curious, how would you think about striking the balance between equity and cash when employing, say, your first 5 to 10 employees? And what do you see as kind of like a starting point to think about what is the right balance? Sorry.
Yeah, it's a great question. And I guess I would first offer that, depending on how the company is capitalized, my general recommendation for folks, often as first-time founders, the mistake we see is that they think that even if they have money in the bank, they should convince those first 5 employees to take, all equity and starve themselves on cash. And the challenge we see with that is that, at least in my experience, most startups are really hard. And when times get tough, if they can't pay rent and they have a whole number of other stresses at home, because they're stressed out, they can't go out to dinner with their friends, they can't go to their friend's wedding, it creates a bunch of retention issues. And so it's actually not healthy to have them, live on ramen if the company has capital to pay them a meaningful salary. So, generally we recommend that you spend time with each employee, really understanding, to the extent that you can, where they're at in terms of their lifestyle needs, et cetera. And then you want to make sure that you're giving them cash compensation so that they can give you 100% of their attention and energy without having to stress that they're not going to be able to do the things that they might need to do outside of work. The last thing you want is someone who, took the equity option because that's what you as the founder sort of sold them on and wanted people that were committed, but then what you're not getting their full productivity because they're overly worried that they can't do a number of things, including go to their brother's wedding, buy a gift for something, take a vacation, go out to dinner, date. We've seen all these issues. So I guess somewhere in there is it tends to be pretty personal, the specific ranges that we see. But that's, I guess, high-level guidance I would give relative to mistakes we've seen. And then in terms of other trade-offs, I think we do see many startups who offer some set of options, like you can pick this package in terms of equity and base, and then a different option in terms of equity and base. And again, a lot of first-time founders find that they really want employees to choose the path that offers more equity all the time. And I guess just to maybe having been around for a while, with you and as you know, Joe, that people have, sometimes have constraints at home and have other reasons that they may be taking a package that has higher cash comp that's unrelated to how committed they are to the company.
Yeah.
And I guess I would just be open to that as well as you try and lay those options out in front of folks.
Especially with, there are startup people who have kids who, maybe are going to private schools or whatever versus, single employees who can take way more risk because, they have very low overhead overall. So, yeah, definitely seen that. And it's been interesting, as I've been hiring people just to see, sometimes you take it as, well, he's not very committed to our company. He wants $200,000 and he doesn't really care about the stock, but it's just the reality of the situation. Like, all things being equal, they'd love to work at a startup, but they've got to be able to pay their bills or whatever it might be. And that's across the board from, engineers all the way through to sales and marketing execs. Typically that kind of stuff goes on.
Not only would I agree with that, and I think like if the employee has kids, you can make assumptions, but one of the mistakes we see is often, you may have someone who's younger who doesn't have kids and be frustrated that they've picked a package that has higher cash comp. And there's a specific example I can think of where a founder was trying to recruit an employee, and what we didn't know is that employee was actually supporting his entire family, behind the scenes, and so he just needed to pay.
Wow.
He had a high burn that was not related to his expenses. He was actually living very cheaply, but without knowing some of those things, and you could easily reach the wrong conclusion about the person and their commitment to the company.
Makes sense. All right, we have another email here. This one's from Larry in Yuba City. It's about finding the right funding partner. So the question is, it's not just about getting money. How would you suggest that an entrepreneur should go about finding the right fit, I think, with an investor? And then part two is, what would Saar suggest from his experience is the right time to seek outside capital? So those are kind of two different questions, but why don't you try the first one about fit with the right funding partner?
Sure. Yeah, fit is really important for any entrepreneur with their investor, and the model that we tend to think about at CRV is we spend a lot of time with our entrepreneurs early on, just building a high level of trust. I think if there's a high level of trust between the founder and the investor, you can work through all sorts of issues, good and bad, through that journey. And the second, to me, that's important is accessibility. There's a lot of folks who, even if you have trust, but if the investor's never accessible when you need them, it's hard to get any value out of them and really have a real relationship. But I jokingly think it's similar to my relationship with my wife. Where I both need to trust her, but I also need to see her and spend time just talking to her.
Yes.
To have a real meaningful relationship with her. And I think the analogy with investors, I think, is somewhat similar in that I think you want to build that trust, and often you'll see investors when they are negotiating with you, when they're talking to you about your company, depending on the words that they use and the actions that they take, to us, many of those are signals of distrust, right, or lack of faith in the founder. And you can pick up on that body language as you're entertaining, talking to different investors. For us, our role is we know the founders are the ones really building, they're responsible for building the companies. We work our asses off to try and help, but it's not our role to stick our hand on the steering wheel and tell them what to do. We don't want to back founders that necessarily listen to everything we say. And that starts, again, with a high level of trust in them and their abilities as entrepreneurs. And you can sense many investors, I think, start a relationship with an entrepreneur from a very different place.
Well, and in my experience, you want to work with people in an ideal situation where you've actually developed a bit of a relationship over time. Like, they're not an investor in your company, but you knew them because you met at a party, or you've done a couple things together, and that sort of builds a really good base of trust over time. Because I always tell people I don't invest in things that I'm not personally interested in, where I love spending time with the founders or the exec team or whoever it is, because life's just too short. And so when people are out looking for funding, I always tell them, your investors kind of have to fall in love with you, with the idea, with you personally, just with the market space overall. If they're not interested in sports, they are not funding your sports startup unless you somehow prove to them that this is going to be the next billion-dollar opportunity. So don't even waste your time. And then the second part of Larry's question was around the right time to seek outside capital. So what do you think about that? I mean, there are a lot of variables in that question, obviously, but.
Yeah, that's right. I mean, we could spend an hour on that alone, just because I think it really depends on the type of business that you're building, and not only when do you seek capital, but what sort of capital do you raise. If you're working on a real estate project, or you're running, you've started a great restaurant, or even in technology, you may be building websites for folks, and in many cases, you may want outside capital, you may need outside capital. You may consider debt in some cases, depending on how far along you've gotten with your business. And then in the classic sort of venture space, we see some companies that are very capital intensive just to test a minimal viable product. So in that case, we have entrepreneurs all the time who come to us and they need to raise $10 million, before they can even build a prototype. And in other cases, like in the consumer space, you have great stories like Mark Zuckerberg, who built a product that was growing really fast before he ever raised any capital from venture capitalists. So you've got a wide range, and I guess it depends, depending on the type of business and the type of product that you need to put out in the market to test the concept.
Absolutely. So once again, this is an interactive show. We want to hear from you. So you can call us. The number is toll-free 844-4-FOUNDER. And don't forget the middle 4. Our email is help@founderline.com. And we're looking at those emails as they're coming in live. Or you can tweet to @Founderline, and we'll try and answer your questions there. So this is the part of the show where we have to do a few commercials just to pay the bills. So this show is a bit of a labor of love, but it wouldn't be possible without the support we're getting from our two amazing sponsors, Orrick and Ustream. You're watching this live now on Ustream, but first I'd like to talk a little bit about Orrick and thank Mitch Zuklie. Mitch and I have known each other for probably 10 or 12 years now. We worked together on a previous company, and we've kept in touch over the years. And when I first told him about Founderline, we were just catching up over the phone, and I said, "Hey, I'd love to figure out a way to work with you." And his response was, "Let's do this." And so I just love that there was no hesitation. Everyone there has been fantastic getting us set up, and I know because I've worked with these guys and gals, and I know what a great job they've done for me and what a great job they can do for you. So if you're a startup, you don't want to think about your lawyer just as the person who's doing your legal paperwork. You want to think of them as sort of your trusted advisor in the same way you would with a VC or anybody else who you're surrounding yourselves with. I've found that that like the most that I get out of the relationships with my legal team is more on the advice side, just because they've seen so many more transactions than just about anybody else, more than most investors, and definitely more than most VCs. They've seen the ups and the downs. They've lived through all sorts of shenanigans, and so, you know, if you're looking for somebody to help you out with your company, Mitch and Orrick are the best. So give them a call. You can go to Orrick.com and check them out. Mitch is on Twitter at Mitch Zuklie as well. The other company I'd like to thank is Ustream. So Brad is the CEO there, and you know, we reached out to Brad originally and said, hey, we're thinking about doing this show. And once again, he said, love the idea. You know, we definitely want to work with you guys on this. And you know, the process has been extremely painless. I literally, from the moment we started to set this up, we had a live stream working in about 10 minutes, and I'm not making that up, which was fantastic. So the whole team over there, you know, worked with us on getting this set up. The broadcast quality, we're broadcasting in high def, and I'm sure you can tell. Hopefully, we're not too ugly on screen, but it's always a danger in high def. But you know, they're the best. And so, if you're thinking about doing any you know, streaming of a show or company meetings or whatever it might be, just go to ustream.tv. That's their website, and you can go find more information. And I'm sure the team over there will take just as good a care of you as they have us. So it's time for our first installment of a segment we like to call Ask the Lawyer. And what we're doing here is we thought it'd be great to have Mitch Zuklie on to sort of walk through you know, a question that might come up on the legal side. So we have Mitch, who's the chairman and CEO of Orrick. Mitch, are you with us on the phone?
Hey, Joe, I'm here, and really psyched to join you and Saar, and thanks for the warm introduction.
Awesome. It's great to have you, Mitch. So, you know, one of the things we're going to try and do with this segment is cover one legal topic. And so for those of you who aren't in Silicon Valley, you know, this might be a little bit, you know, inside baseball, if you will. But since we've got, you know, such a great group of people here with us today, I thought we could talk a little bit about a topic that's been in the news, which is CEOs getting removed from their position at a company. And there was a recent high-profile situation that I'm sure many of you have seen. And you know, Mitch, I think the question really is, well, there are two pieces. One is, you know, what are the circumstances under which, you know, a CEO can be removed from their position? And we all hope that doesn't happen, but we've lived through those situations. I've lived through that situation personally. And then secondly, you know, there was a bit of a misperception around if the CEO owns more than 50%, well, they can't possibly be removed from their company. And so walk us through, you know, how this stuff works, and then Saar and I can chime in with some of our experiences as well.
You bet. I'd be thrilled to do it. And I should just say, by way of disclaimer, that if you're listening today, whatever I'm telling you here is not legal advice. I'm not your lawyer. We don't have an attorney-client privilege relationship. But I'm glad to answer it in the abstract. And, you know, it's actually one of the more thorny legal questions, and one of the more carefully crafted ones when you actually go to do a venture financing. The general rule is the bylaws determine what happens with respect to the governance of a company. And almost always company bylaws say that the appointment and the removal of any officer, including the CEO, is determined by the majority vote of the board. That's almost universal. And so what that means is if you control a majority of the board of directors, you're able to remove someone as CEO of the company. And so that's the cornerstone sort of piece of information. Now, very often, the question becomes, well, if you have a majority of the stock, can't you appoint a majority of the board? And it's in that intersection of, okay, you have a majority of the stock, but there's a perfectly well-appointed board. How would you remove board members who are existing board members and replace them with your slate, where there's a lot of legal wrangling that can happen? And I say can because it happens incredibly rarely. I've been doing this for 18 or 19 years now, and I think there's been 3 or 4 instances in my career where we've seen a situation which has been contested, where these provisions are really called into play. So it just doesn't happen that often. And it's typical that that where you've got a situation where you've got a venture investors, very often what will happen under something called a voting agreement is there'll be an agreement about how the board gets put together. So it'll typically say something like 2 board members are selected by the holders of majority of the common stock, often a majority of the common stock held by the founders. Then maybe 2 seats go to the venture investors, and 1 seat might be an independent. And so actually, if there was a situation which was drafted to say a majority of the common stock got a couple seats, a majority of the preferred got a couple seats, and the preferred held a majority of the stock, the preferred guys might be able to convert their preferred stock to common and therefore control the slate altogether. And so very frequently there's a heavily negotiated provision describing whether it's a majority of the preferred held by the common, held by the founders, or whether stock can convert in terms of measuring the majority of the common stock. So bottom line is, it's a pretty complicated area, and it's the intersection of voting agreements, bylaws, the certificate of incorporation, and Delaware law or California law, which are the 2 most common, which really answer all this question. So it's not at all surprising that it can be challenging to remove a CEO, particularly one who's got a majority of stock. But in no ways is it definitive that someone who's got majority stock will be able to control the board. And at the end of the day, this is about the most heavily contested sort of provision. When these things are called into question, it's generally not a good situation. And I would say the overwhelming majority of the time where you see folks leaving, there isn't a legal wrangle over it. It's a decision made by folks that's probably just time to move on, or perhaps even a settlement around how they will move on and what accelerated vesting might be part of the provision in exchange for a release. Because the situations where you actually find a fight and legal provisions and a potential contested board seat coming up are exceptionally rare, and they're generally very damaging to the company to have to go through that. So it's really not in the best interest of the investors, and certainly not in the best interest of founders who typically have a big chunk of the common stock to engage in that sort of a slugfest. Far better to be in a situation where you sort of find a way to resolve things amicably and sort of move in separate directions. Hope that helps clear it up a bit.
Yeah, no, that definitely helps. And Mitch, I think it brings up a great point. I always tell entrepreneurs that board control is one of the most critical aspects of your decision around funding, and because most people, they don't worry so much about it. They're worried about how much money is an investor putting in and what's the valuation. And meanwhile, there's 3 board seats going to the preferred investor who's putting in $1 million, and that doesn't make any sense. And Saar, maybe you can pick this up as well. Maybe talk about, like, in these early situations, like maybe it's where it's first money in. What sort of board are we seeing in those cases? Is it typically a couple of founders with the first investor in, or what do you see in those cases?
Yeah, it's a great question. So most of the investments we make are again very early stage, close to the founding of a company or within months of a business kind of getting up and running. And so usually the board at that time when we invest tends to have the founding CEO. Sometimes it may have, let's say if there's 2 or 3 founders, all of them may be on the board, or 2 of the 3 may be on the board, and then usually myself or another CRV representative.
Got it.
And then what we find is, as the company goes on to do subsequent financings, we can expect other investors to join the board with each of those next rounds, and Mitch can speak to this, but generally in each round there tends to be a representative for that new class of shares, representing, let's say if we do the A round, I may represent all of the A Series A preferred
Right.
shareholders, even if CRV may not be the only Series A preferred investor. The Series B may have a board member representing the Series B, et cetera. And then as companies progress, or sometimes very early on, we'll find that some founders or some boards decide they'd also love to have an independent board member. That person could serve as a CEO coach. That person could also just potentially help with branding or fundraising or other advice. Those people can serve a number of different functions.
Mitch, what do you think? What's the typical structure there?
I think Saar got it just right, which is you're by the time you get to an A round, I think you're likely to have a situation where you'll have one or two venture investors and probably a parallel number of founder investors, and likely an independent. And as you progress through later rounds, that may shift a bit so that you have a majority held by the investors. And I think that your advice around the concept of really treating those board seats as critical relationships is right. I like to tell my clients that are thinking about this that those board seats are things that you should treat as important as gold. They are absolutely relationships. Saar made reference earlier to the idea that sort of a relationship like the kind of relationship you might have with your spouse, where you've got to have a lot of open communications. And I think that the person that you pick from the investors is a critically important one. And I always advise my clients to be very clear and specific. If there's a partner that you like, whose track record that you respect or you find you've got a good relationship with, to really specify that that's the designee you want from that firm, and to figure out what happens if he or she goes on to do something else. And further, I think of that independent seat is one which can be really valuable to founders who can be, a consigliere and a coach, someone who, Saar mentioned a couple different ways they can help, but that idea of being an independent sounding board who has a currency and credibility with the venture investors, it's an important position. Very often those seats go vacant. They are, I'd say in the majority of the cases, they are not filled. And I think if there's a possibility to fill them, it's generally to the great benefit of the company to do so if you can find someone that everyone around the board table respects. And I've seen many instances where I think the independent board member has been dispositive on a positive outcome for a company. So I take a lot of time on those things. They're the most important part of your term sheet, in my view, isn't price or protective provisions or any of the other stuff. Quite frankly, it's board composition, and the most important factor that will come into play will be the quality of the advice you're getting around the board table. So I think this is a really important one. It's one we spend a lot of time working on and making sure people understand it.
Great. Well, Mitch, thanks for joining us, and we'll talk to you again next week.
All right, Joe. Look forward to it. Saar, nice talking with you.
Yeah.
Take care,
Thanks,
Mitch. All right. Well, that's Mitch Zuklie from Orrick. Some great advice on CEO situations and board composition, one of the most critical factors in a startup. Let's see. We're around 5:45 p.m. and again, if you want to give us a call, 1-844-4-FOUNDER. That's 3 4s in there. I kind of screwed that up. Or email us at help@founderline.com or tweet to @Founderline, and we'll try and answer your questions. So we got about 15 minutes left, Saar. Let's see. I think we have a call from Palo Alto. We have Michael in Palo Alto. Michael, welcome to Founderline.
Thanks, guys, for taking my call. My question is more from the employee of a startup point of view, so it might be pretty layman compared to the other questions you've been answering here. But for working for a company that's actually doing really, really well, and then the future looks really good as well, but the VC is putting pressure on the company to sell it. And I'm wondering what kind of motivations there might be for that. Is there a disagreement about the future value of the company, or do they want the money back to reinvest it or something like that?
Got it. So the company's doing really well, and the VCs are putting a little bit of pressure to sell the company. And I mean, this could be even more broad, right? This is the famous, someone gets offered $3 billion, and then a decision has to get made around, do we accept that acquisition offer or not? So Maybe talk about some of those dynamics. Like what are those evil VCs thinking when these sorts of things go on?
Sure. Yeah, I'll offer a couple comments. One of which is actually maybe less obvious, but in some cases we actually see CEOs who use the board as sort of like the kind of I don't know, an object that helps them, it sort of empowers them, and so they can blame certain decisions on the board or on the venture investors, and it allows them to make hiring, firing decisions, et cetera. And so I guess the first comment I'd make is that may actually be totally true, and the CEO may be telling you the truth and be totally transparent. I would expect that to be the case. But in some cases, we have CEOs who sometimes, for whatever reason, they'll use the board and the venture guys as the decision makers and sort of put it on us, even though we may not actually be the ones driving that decision. So I just put that aside. That's probably not what's happening in your case.
How does that make you feel when you find out that's what they're doing? Like I've lived through that, and I've seen, oh well, the board said we can't do that for you. We can't get you Diet Coke in the refrigerator. I mean, you're just like, come on, are you serious? Like,
well, I'll tell you, it does serve a purpose. The most common place where we see that is actually in employee negotiations, where the CEO says, I want to hire Joe as my VP. I'm going to go to bat and ask for this compensation package. And then they go into the room and then they come out and they say, the board is not supportive of this package. We'll give you $25K less. And it's a negotiation tactic, that is probably more common than I think many employees recognize. And there's often truth to what's happening there, and there's often, it's just a tactic. As it relates to, why a venture firm would put pressure on the company to sell, there's also a list of answers there. Many venture capitalists, I think, actually would really trust the CEO and the CEO's view of the market in what in terms of whether it's the right time to sell. We think great CEOs know the market better than anyone, and if they really want to keep going, they must know something, they must see something, and generally the VCs will want to get behind that. That being said, that's not always the case. Sometimes the VCs may not actually have that faith in the CEO, or they may have a different view on the market based on other market activity that they're seeing. Or there can be entirely other sort of other factors happening in the background. So another example can be, depending on who that investor is, we are very, very fortunate that we're investing out of our 15th fund, and we've been able to make a lot of money for our investors over 40 years. There's a number of firms who our business is quite difficult, and there's a number of firms who have not been able to deliver great returns to their investors, and they can't raise another fund. And so those firms often, if they want to go fundraise, need to show that they're putting points on the board and that they can generate outcomes. And it's often in those cases where we'll see some of our partners who may just be weaker partners in terms of their staying power. They will do strange, irrational things to us, from our point of view and from the entrepreneur's point of view. But what they're really trying to do is, get a sale so that they can go hit the road and raise their next fund. And so whether a company is doing great, if they can generate a return, it may not be the best return if they kept going with the company. They may be actually just pressuring the sale because of other things happening in the background as it relates to their business. Because just like the entrepreneur has to go raise money from the venture capitalists, we actually have to go raise money from other investors ourselves, and we need to show a track record, and that track record ultimately is from generating returns and exits.
Well, and I think that's a great point, because it's always critical to know what is somebody's motivation behind whatever it is they're pushing or not pushing or whatever it might be. And having lived through some of those situations where you're pitching an investor and then you later find out that they don't have any money to invest because they haven't closed the new fund, or they're in the middle of funding a competitor. I had this happen to me personally. A very major VC, first meeting, guy said, I want to get you a term sheet tonight. please send me all the documents so we can distribute them throughout the partnership. And then he went dark. And I was like, what is going on here? I called, I emailed, no response. And it turned out like a month later, he was funding something that was very similar to what I was doing. And so just understanding the motivation, like you said, do they have the money to invest or not? Or even, same thing with CEOs. Like, why is the CEO telling me this? Is it because he's trying to cover his ass, or is he does he truly believe that? What's going on there? I think those are great points. So we've got a couple more emails here. This one is from Renee in Silicon Valley. I'll just read it to you so you have a chance to answer back. I have the opportunity to join a startup as employee number 9 as a product manager, but I don't know the founders, and I haven't heard of the out-of-state company they started and sold. They say it was a modest success in an unrelated market. I've been offered 1% apparently equity and a reasonable salary. So I think what she's asking is, how do you evaluate an opportunity like that where maybe the comp looks good, but you're not sure about the people, or there could be some factors that some warning lights are going off in your head.
Mm-hmm. Yeah, Renee, it's a great question, and I guess without knowing the company or the product, I'd be happy to give you my opinion on those if I knew it. But I think in some cases you have to use your own judgment, in terms of evaluating, has the company, at what stage is the company? Has it found product market fit? Or are you the one that's really going to be responsible for finding the product and building the product that's going to work? There's potentially different levels of risk associated with that. If you're if you're with a company that's already figured out what they're doing, then one offer may look much better than taking on a ton of risk, to try and discover what product is going to work in a particular market. A lot of folks join startups where they're not funded. They're drawing very little salary, or they have no equity. I would offer that if they're paying you a reasonable salary relative to what you might be making somewhere else, and they're offering you 1% of the company, that seems generous for being in the first, call it 20 employees of a business, roughly, depending on how much runway they have and how long they could pay you that salary. So those are the things I would probably, if I were in your shoes, ask yourself: is this a market that I believe in? Is this a product that uniquely solves a meaningful problem? Have they figured that part out? Have you spent enough time with the founders to at least believe in them that they are the right folks who will figure that out? If you have confidence in those areas, then and you've asked the question of how much cash they do have or how long they could pay you for, then it sounds like it could be a good offer.
Yeah, and I would add to that, just knowing like who the people are and getting to know them better, and you're going to be in the trenches with these people, and if you've not worked with them before, your work styles might clash, and you may not be a good fit. So spending as much time as you can up front getting to know them, I think, is a really critical piece of that, because at the end of the day, it's the people you work with, and yes, the product you're working on and those sorts of things. But if you don't like the people you're working with, you're gonna hate it. So make sure you spend quality time with the founders or anybody else who's on the team to get to know them better. We're running low on time, but I have to ask this question, and it came from somebody, and this is more of a generic thing, but someone who tried to reach you a couple of times via email and didn't get a response back. And I think people have to know, like, as an investor, you get literally tens to hundreds of emails every day from people who want to pitch you. So they want to know why didn't they hear back yet and what's going on. So maybe just talk generically about the demands and like how you handle the incoming wave of all the opportunities that come to you, to give people a sense of how a VC operates.
Sure. Yeah, I guess first of all, I guess it's frustrating to not know who the name is, who the person is, in that we try and be responsive to most folks that email us. That being said, in many cases, we find a lot of great entrepreneurs, will try and continue a thread of, we'll say no or we're not interested, and they'll keep pinging us, and at a certain point we just don't have the bandwidth to keep responding and saying no. It's sort of like answering my young son sometimes.
Yes, with the repeat questions, right?
That's right. But beyond that, we definitely try and be responsive and read emails. But that, you are right. We get hundreds, if not thousands of emails a week from folks that we don't know. And I think there's a lot of data and content out there that says, you can sometimes get a meeting with a VC through, people that, just through an inbound email, but it generally will be because it's in line with something that we've already stated, in the media or through a blog post that it's an area we're interested in. If I say I'm interested in transportation and I want to see everything related to transportation,
right,
and you're working on a transportation startup, we're likely going to read and respond to those emails. But in some cases, unfortunately, we just can't respond to every email from people that we don't know. We tend to recommend that if you really want to get to us, a great path is through our networks, and find someone who knows us well, who can vouch for you, who's willing to ping us and make an introduction. I think we respond quite quickly to all of those, and really build our network that way. But we work pretty hard. We don't get a lot of sleep. We spend a lot of time on email, just trying to offer some level of sort of customer service to entrepreneurs who inbound us. But the caveat is we're not always able to do that.
Great. It's a tough job, and it's sometimes hard if you feel bad, like you're not getting back to people, but it's just a question of prioritization.
I'd also just add one other comment, which is I think the other thing is, at least for us at CRV, we spend a lot of time. We don't invest often, and when we do invest, we spend a lot of time with our founders. So I think there's a number of other investors who probably spend 90% of their time just looking for new investments. We actually love the company building side of things, and so it's part of our job to find new investments. It's not all of our job.
Well, believe it or not, we're out of time. This has been fantastic. We probably could have gone another hour, but Saar has been a great guest. Thank you for joining us. Again, Saar's at CRV. You can reach him on Twitter at Saar, Saar. Next week, we'll have another episode of Founderline. Our guest is going to be Paul Martino from Bullpen Capital, who actually was an investor in my last company. He's a great entrepreneur as well. He started Aggregate Knowledge and was an investor in Zynga as well as FanDuel. And now he's the founder and general partner of Bullpen Capital. So next Thursday, 5 o'clock Pacific time. Once again, I want to thank our fantastic sponsors, Orrick and Ustream. We really appreciate you guys getting behind us. You can follow us on Twitter. We're at Founderline. If you have questions and we weren't able to get to them, we're sorry, but just email us, help@founderline.com, or check out our website. You can subscribe to get email updates from us, watch previous episodes, and see who the future guests are going to be. Thanks for watching. Here's to the crazy ones, and we'll see you next week.